Welcome to Stuck, Time to Improv. I'm Mary Scott with Business Riff, and we have advice for startup businesses. And today I have Jeff Werner from Field Holding, and he's an angel investor. So we're going to talk about the different stages of investment. And we're going to tell you what all the names are and what happens at each point. So welcome, Jeff.
Thank you. Thanks for having me.
So let's talk about the stages of startups. You hear terms flashed around by like pre-seed and second stage. And let's start at the beginning and tell people what it is and what it means.
Okay, so the stages, they tend to follow a pattern and a path, but when you come to fundraising, they're the general names. I mean, like say the first one's friends and family, which is literally that, friends and family. So oftentimes a company will do a friends and family fundraising round. And as it sounds, you're knocking on the doors of your friends and family to write you a check for your endeavor. So a lot of people, a lot of entrepreneurs that I know, their friends and family list, though, don't quite go far enough. So you also are knocking on the doors of maybe some early stage angel investors. Not typically an angel group that we discussed on a prior program, but more of an independent angel who might have an affinity for what you're doing, they recognize such as something in the marketplace. Maybe they want to come along and help with advisory or open up their proverbial Rolodex and help out.
What kind of dollar amounts are we talking here?
So in a friends and family round, we typically see at the minimum end of $5,000. Usually not more than 50,000 from an angel. Mom and dad will do what mom and dad will do, but 50 is actually pretty unique, but I've seen it. Usually these are 5,000, 10,000, 25,000 range. Mm-hmm.
Okay, and then the next stage?
So the next stage we call pre-seed, and the idea is through the friends and family round, you've developed, you've clarified the business plan. Maybe you have an MVP, a minimum viable product, and you're starting to show a little bit of market interest. You're starting to define your space in the market, and you'll raise a pre-seed round. That pre-seed round oftentimes be like $500,000 to $1 million is what we typically see in that range. They can be more, not usually less. The effort to go through it for smaller amounts of money probably isn't worth it. So that's a pre-seed round, and it's still early stage angels. You might win a couple of pitches for some angel groups in that situation, but it might be a little bit more work to get them to write the checks.
And then next is the seed round.
Okay, a seed round is correct. So in a seed round, you've at least have the beginnings of a product market fit. Or if you're some type of company that are doing, like say you have some pilot programs launched and such. Now, when I started on this seed rounds, I've seen also we're like more like pre-seed rounds, $500,000 to $1 million. But now we're seeing seed rounds. $1 million is a small seed round. So about $1 million to $2 million, sometimes as much as $5 million. But there has to be some reason for the amounts, for that kind of amount, an upper level amount.
So at this point, you would expect that there's some profit being made and the extra money is for growth to expand markets or something?
Actually, not necessarily. So this is an interesting bit.
Okay.
Profitability on a company at these stages is not that important to an investor. And yes, this is a conversation I have with many founders, that an investor is looking for equity growth more than cash growth. Really, we want to see that if you're making profit on a per unit basis, it needs to get reinvested into the growth of the company. So profitability is not that important. as long as there's a plan to grow the value of the company.
All right. And that means more equipment, hiring more employees, expanding markets. Okay.
Sure. Yeah, any of that, it will vary depending on the business itself.
Okay. So seed round, and then what?
Then what? Well, I think it's important because it comes up at least 50% of the time is a bridge round. Okay. So between any of these would be a bridge. And that is just as it sounds. Some short-term, usually smaller amounts of cash to get from point A to point B before you're ready for the next round. So this is a really, I think, an excellent strategy. I advise my companies a lot on this, is that let's say you're close to a major milestone, but you just don't have enough financial runway to get there. You could move to your next round and start raising it, but that next round is probably a larger amount of money. You're going to open that next round, if you try to get the larger amount, on a lower valuation because you haven't achieved enough traction or growth yet. So it's better to preserve the equity. So you might do a bridge round for, say, a few $100,000 as an example, at a lower valuation so that you can achieve the one or more milestones before the next round where you can command a higher valuation and then raise the larger amounts of money. A bridge round is an incredible tool in the toolkit.
Okay.
Right.
And the next tool?
So the next one we go to is a Series A. Now we're getting into venture capital territory. Although little asterisk there as well is that venture capital, there are early venture capital which will come into seed rounds as well for some companies. But Series A, the key thing there is you really pretty much outgrown the angel. You might get a follow-on investment. So your existing investors as angels who came in earlier might add to their investment. But usually a Series A, it tends to be a little late for the angels. And the numbers are higher. So the amount you're raising is higher and the valuations are higher. So you're really talking about venture capital funds. Okay. These funds are very specific, often very specific to particular sectors, and they invest not only on the deal itself, but their ability to really come alongside, help the company with their network and their knowledge, and they really just look to create velocity in the growth of the company.
Okay. Now, here's a question is when you get to do the venture capitalists supplant the angel investors? Do the early investors kind of drop out when the bigger guys come on board?
So that will happen sometimes. So sometimes there's an offer, like a venture capital will say, you know what, there's so many investors on this cap table. We want to own more of the company anyway. Can we buy out the early investors? So that can happen. Okay. Other times it's like, okay, the early investors are still on the cap table. They're along for the ride, but the angels who may have helped early on tend to fall back and not have, it's a little harder to get a hold of the CEO, for example. The help that an angel can do may not be at the level that the company can do. Okay. That said, relationships are everything. So if you forge an early relationship, I'm sure the CEO will take the call. And certainly if there's an angel with a unique knowledge in the space, those dialogues will continue.
Okay. And take us further?
Further is really just goes Series B, C, D, and grows from there. I think it's really versions of the above, but I would say that as a generality, as you go into your later series, it really starts becoming about the numbers and the returns for the investors and how far away that exit is.
Right. So and at that point, you have to have a good board of directors and
absolutely
know what's going on. Okay.
Absolutely. Yes. Board strategy at an early stage is really important as well.
Okay. Well, now we know the stages of investment for startups. Thank you so much, Jeff Werner.
You're very welcome.
Mary Scott from Business Riff. I help startup businesses expand into new markets and connect with custom resources through my business concierge services and consulting. So join us again for Stuck, Time to Improv.